Welcome to our deep dive into the future of stock markets. This is Andre from Silver Bullet Investing. Today we'll explore the key challenges that could shape the investment landscape over the next 40 years. We're talking about the big kahunas, the game changers, the stuff that keeps you up at night. Fasten your seatbelts because we're about to embark on a wild ride through the treacherous terrain of the future stock market. We're going to break down the walls of worry, expose the booyahs and the bear traps, and give you the ammunition you need to navigate this market maze. This isn't for the faint of heart, folks. This is for the investors who are ready to stare the future dead in the eye and say, "Bring it on." Listen up, because this is where it gets real. We're diving into a topic that's going to affect every single one of us, whether we realize it or not. We're talking about the aging population, a demographic shift of epic proportions. This isn't just a minor change, it's a seismic shift that's going to reshape our world in ways we can't even fully comprehend yet. Think Japan, folks. They've been grappling with this for years, and let me tell you, it ain't pretty. Japan's experience serves as a cautionary tale for the rest of the world. Their economy has been struggling under the weight of an aging population, and the lessons are clear. Fewer babies, longer lifespans, it's a recipe for slower economic growth. When the birth rate declines and people live longer, the balance between the working-age population and retirees gets thrown off. Why? Because when you've got a shrinking pool of consumers, demand dries up. Fewer young people means fewer shoppers, fewer people buying homes, and fewer people investing in the future. And when demand dries up, corporate profits take a hit. Businesses start to struggle and the entire economy can feel the strain. It's a domino effect that can lead to widespread economic challenges. It's a vicious cycle. Think about it. Who's buying the latest gadgets, the hottest cars, the trendiest clothes? It's the younger generation, the ones who are driving consumer trends and keeping the economy vibrant. Not grandma and grandpa. They're more interested in healthcare and retirement planning. Their spending priorities shift from consumer goods to services that support their health and well-being, and that, my friends, is a whole different ballgame. Financial planning, healthcare costs, and retirement savings become the focus, rather than spending on new products and experiences. We're talking about a potential drag on consumption, a shift in spending patterns, and a whole new set of challenges for businesses to navigate. Companies will need to adapt their strategies to cater to an older demographic. This isn't just a Japan problem, folks. It's a global phenomenon that's coming to a market near you. Countries around the world are starting to see similar trends, and the impact will be felt far and wide. The Silver Tsunami is here, and it's time to prepare. Remember the good old days when globalization was all the rage? When the world seemed to be shrinking and borders felt like mere lines on a map? Companies were setting up shop overseas, tariffs were falling, and the world felt like one big, happy marketplace. It was a time of optimism, where international cooperation was the norm, and businesses thrived on the global stage. Well, folks, those days are over. We're entering a new era, an era of geopolitical tensions, protectionist policies, and a whole lot of uncertainty. The landscape is shifting, and the rules of the game are changing. Trade wars, pandemics, you name it, it's all contributing to a slowdown in globalization. The interconnected world we once knew is facing unprecedented challenges, and the ripple effects are being felt across industries. And what does that mean for stocks? Well, for starters, it means supply chains are getting disrupted. The seamless flow of goods and services is no longer guaranteed, leading to delays and shortages. Remember the great semiconductor shortage? That's just a taste of things to come. As supply chains become more fragmented, industries that rely on global networks are particularly vulnerable. We're also seeing a rise in regionalization, with companies focusing on producing and selling goods closer to home. This shift aims to mitigate risks but comes with its own set of challenges. And that could mean higher costs, reduced efficiency, and lower profits. Localizing production isn't always as cost-effective as leveraging global supply chains, and businesses are feeling the pinch. The bottom line is this: globalization is slowing down, and that's creating a whole new set of challenges for businesses and investors alike. Navigating this new landscape will require adaptability, resilience, and a keen understanding of emerging trends. As we delve deeper into the factors shaping our financial landscape, we cannot ignore the profound impact of war and geopolitics on the stock market. The reverberations of geopolitical tensions are felt far and wide, shaping investor sentiment and market dynamics in ways that can be both immediate and long-lasting. In recent years, we've witnessed a resurgence of geopolitical conflicts. From trade tensions between superpowers to regional disputes escalating into armed conflicts, the geopolitical landscape is fraught with uncertainty. Historical context shows us that wars and geopolitical strife have always had significant impacts on financial markets. Just look back at the oil crises of the 1970s, the Gulf Wars, or the more recent conflicts in the Middle East. Each event sent shockwaves through global markets, causing volatility and reshaping investment strategies. Today, the stakes are higher than ever. The interconnectedness of our global economy means that a conflict in one region can have ripple effects across the world. Take the Russia-Ukraine conflict, for instance. The sanctions imposed on Russia and the disruption of energy supplies have had far-reaching consequences, affecting everything from energy prices to agricultural commodities. Investors are left grappling with increased volatility and uncertainty, making it harder to predict market movements and allocate resources effectively. Looking ahead, the potential for future geopolitical conflicts looms large. Rising tensions in the South China Sea, the ongoing struggle for influence in the Middle East, and cyber warfare are just a few examples of the flashpoints that could trigger market turmoil. Investors must remain vigilant, as the geopolitical landscape is as unpredictable as ever. The bottom line is this: war and geopolitics are powerful forces that can upend markets and reshape the investment landscape. Understanding these dynamics and staying informed about global developments is crucial for navigating the stormy seas of the financial world. In a world where the drums of war can beat at any moment, staying ahead of the curve has never been more important. Let's talk about debt, the elephant in the living room. Government debt, corporate debt, consumer debt, it's everywhere you look. And let me tell you, it's a ticking time bomb. When governments are drowning in debt, they have less money to spend on things like infrastructure, education, and research and development. And that's bad news for economic growth. Corporate debt is no picnic either. When companies are loaded up on debt, they're more vulnerable to economic shocks. And if interest rates start to rise, watch out below. And let's not forget about consumer debt. Credit card debt, student loan debt, auto loan debt, it's all adding up. And when consumers are struggling to make their debt payments, they have less money to spend on other things. The bottom line is this: rising debt levels are a major threat to the global economy. And that's something investors need to be very, very worried about. Listen up, because this is important. What we're about to discuss could change the way you think about the future. Climate change is real, it's happening now, and it's going to have a profound impact on the global economy. We're not just talking about a few degrees of temperature rise, we're talking about a cascade of effects that will touch every corner of the globe. We're talking about more extreme weather events, rising sea levels, and mass migrations. These aren't just abstract concepts, they're real events that are already happening and will only become more frequent and severe. And what does that mean for businesses? Well, for starters, it means increased costs. Companies will face higher insurance premiums, more frequent disruptions, and the need to comply with stricter environmental regulations. Companies are going to have to invest in new technologies and adapt their operations to a changing climate. This isn't optional, it's a necessity for survival in the new economic landscape. We're also going to see a lot of stranded assets. These are investments that will lose their value as the world shifts away from fossil fuels. Think oil rigs, coal mines, and gas pipelines. These once valuable assets will become liabilities for some of the developed countries. The shift is inevitable, and those who don't prepare will be left behind. With that being said, we have a long way to go before solar and wind are the main energy sources. We might as well be going too fast into this great change, and we may suffer a lot in the transition period, making the old oil, gas, and nuclear the place to stay at least in the next 10 years. Let's not forget that although the developed countries may be transitioning into green energy, there are a lot of places around the world who need to undergo their industrial revolution, representing more than 70% of the global population. Electricity won't quite cut it when it comes to building infrastructure and manufacturing products, so demand for oil will most likely continue to rise slowly. Not to mention the stable electricity needed for life and death situations, which cannot be achieved with green energy. Climate change is a big challenge and a big opportunity of our time. It's a dual-edged sword that will cut both ways, depending on how we respond. Prepare for the change, but be realistic. The world is going to need energy, and solar and wind are not efficient enough for the time being. This is why uranium exploded in the past few years, and at some point I suspect oil and gas will do the same. Let's talk about valuations. Stocks are expensive, very expensive. In fact, they're at their most expensive levels in decades. And that's got a lot of people worried. When stocks are this expensive, there's a lot of downside risk. We're talking about mean reversion, folks. What goes up must come down. Now, I'm not saying that the market is going to crash tomorrow, but I am saying that investors need to be very careful. Don't chase returns, don't buy into the hype, and whatever you do, don't fall in love with your stocks. For the past decade, the Federal Reserve has been pumping money into the economy like there's no tomorrow. They've kept interest rates at historic lows, and they've been buying up trillions of dollars of bonds. And you know what? It's worked. The economy has recovered from the Great Recession and the stock market has soared. But all good things must come to an end, and the Fed is starting to unwind its easy money policies. They're raising interest rates and they're starting to shrink their balance sheet, and that's going to have a big impact on the markets. Higher interest rates mean higher borrowing costs for businesses and consumers, and that could lead to slower economic growth. Thank you for joining us on this journey through the potential challenges for stocks in the next 40 years. We've covered a lot of ground today, from demographic headwinds to slowing globalization to rising debt levels. But don't let all this doom and gloom get you down. Remember, the market is a powerful force. It's constantly evolving, constantly adapting, and so are you. Stay informed, stay diversified, and remember, the key to successful investing is preparation and adaptability. Thank you for watching. Please like and subscribe. See you next time.